Hello friends, welcome to today's webinar. You can't beat a crowd if you are a part of it. The case for contrarian investing, hosted by CFA Society India. I'm Nimisha Pandit, Associate Director and Head of Equity Research at Multi-Act Trade and Investments Private Limited. Before I introduce our speaker, I have a couple of housekeeping notes. Today's webinar is scheduled for 60 minutes, including Q&A session. We will have the Q&A round after the speaker's presentation, but you can start posting your questions right away. You can submit your questions through the Q&A box at the bottom of your viewer. The speaker's presentation will be available afterwards. We'll share the link in the chat box once the presentation concludes. And lastly, we value your feedback, so please complete the evaluation survey before you sign off today. And now let's proceed to the main session. It is my immense pleasure to introduce our speaker, Mr. A Sundaram. Mr. Sundaram is an Executive Director and CIO of Equities at O3 Capital. He has over 3 decades of experience in managing equity investments under multiple formats and in multiple market cycles. He likes to classify his investment style as Commonsense Investing. His thesis is simple. Investment success can be achieved not only by doing the right things, but also by avoiding the wrong things. And Mr. Sundaram has a great track record of identifying wrong things in advance and avoiding them. In his 30 years of investment experience, he has taken significant contrarian positions and saved his clients from losing their money. He was underweight technologies in 1999, infrastructure, utilities, and power sector in 2007, and midcaps in 2017. He had no exposure to NBFCs in 2018. And at the same time, he has bet on companies and sectors which had fallen out of market's favor. We'll learn more about his contrarian investment style in today's webinar. Mr. Sundaram's previous stints included a role as Manager of Research at SBI Mutual Fund, Head of Research and Fund Manager at Zurich India Mutual Fund, Senior Portfolio Manager at HDFC Mutual Fund, Portfolio Manager at M3 Investment Managers, and CIO and Portfolio Manager at PGIM India Mutual Fund. Welcome, sir, you can start your presentation.
Thank you, Nimisha. And first of all, thank you, ladies and gentlemen, for this honor of addressing you this evening. I would like to thank especially the office bearers of the CFA Society and to the operating members, Vidhi, Harshad, and Anne Lynn, for providing this opportunity to me this evening. Like a good portfolio manager, let me begin with a disclaimer. You know, this method that I'm going to discuss with you, I am no way claiming that it is the best. It is a good method, and as we all know, there are dozens of ways in which one can successfully invest in the stock market. I am going to talk about one of them. That's the disclaimer with which I'll begin the presentation. I'll just give me a minute to open the presentation. Nimisha, can you confirm whether it is seen?
Yes, we can see your presentation, but it is not in slideshow mode yet.
I've made it slideshow mode. Is it visible to everybody on a big screen right now?
Not to me as of now. Can you maybe try it again? Okay.
Is it visible now?
Yes, I got a response from the audience that it is visible, so I think we can start.
So let's start. See, as I began by saying that there are dozens of ways in which one can invest in the stock market. I would classify them into 2 broad categories. You know, the first category is trying to do the right things. I think both of them will lead to investment success. Number 1 is trying to do the right things. The other method is avoiding the wrong things, which is what I try to do. You know, when trying to do the right things means finding out the growth prospects, assessing management quality, estimating profit growth and cash flows, and so on and so forth. The other method, which is I would submit it is equally effective, is that just don't buy weak businesses, just don't pay an exorbitant price, and just don't participate in the hype. Now, we'll discuss this in greater detail in the subsequent slides, but this is what I'm going to talk about today. The issues faced by the trying to get it right method, for a lack of a better phrase, I'm using this, is that, first of all, one has to predict which industry will grow the fastest. Within that, we predict which company would grow the fastest, estimate the profit margins, trying to get it right. Not only that, estimate what impact the competitors' moves will have on this company's profits, estimate the EPS trajectory, get the macroeconomic factors right, pay attention to what Shaktikanta Das is saying. Not only that, pay attention to what Jerome Powell is saying, and so on and so forth. Get the political trends right, how much seats NDA will win in the next election, how much UPA will win, what impact it will have on the economic policy. After all of these things, correctly predicting and estimating how much of all of these factors is already factored in the price. Now, I've observed that a great deal of effort goes into all these things. But the thing to remember, in my humble opinion, is that there is an army of highly qualified people trying to do just this. And all of them are blessed with roughly the same level of intelligence. Everybody has roughly the equal educational qualifications. Everybody is a chartered, most of them are a chartered financial analyst. Many of them are MBAs from the top school. Many of them are rank holding chartered accountants. All of them have access to the same databases. Everybody has Bloomberg and the modern databases available. Everybody attends the same analyst meets. Everybody attends the same conference calls. Everybody reads the same transcript. Everybody reads the same journals and magazines. So the point is this: it is very, very, very difficult, if not impossible, for a single person to claim superiority in terms of information edge in today's day and age. That is the point I'm making. So there has to be an alternative. The alternative which I'm suggesting is this. And here our guiding light is the quote by Howard Marks. The best foundation for above average long-term performance is the absence of disasters. So it sounds very simple, but I assure you it is not easy. It's equally effective, but it is far less complicated than the method that we discussed in the previous slide. What is disaster? For an equity investor, what is disaster? For an equity investor, there can be only one thing that can be called a disaster. Disaster is permanent loss of capital. Short-term fluctuations will happen to all stocks, so that cannot be controlled. Disaster is permanent loss of money. And if we have a process to reduce the chances of permanent loss, then that automatically improves the chances of success. That is the theory behind it. The focus, therefore, when we are talking of equity here, the focus, therefore, is to lose less money rather than maximizing returns from equity at all points of time. This is the approach to investing. Therefore, the process assumes paramount importance. What process we follow, the process that is put in place to reduce the chances of those three errors that we spoke about, becomes extremely important. Now, what are the factors that cause permanent loss of capital? There are only three. Actually, there's a fourth, which is the root cause, but these are the three that cause permanent loss of capital. Number one, investment into a company that has a weak or deteriorating business. That is the first cause of permanent loss of capital. The second is investment into a company where the management has shown evidence of going against minority shareholders' interests significantly, and also shown evidence of gross incompetence. So if you buy into a company that is run by management which is either inept or dishonest, then we have a problem. The third and most common reason is paying too much for a stock. This is a depressingly common mistake made by many investors. Even if we buy the best company in the world, if we overpay for it, that leads to permanent loss of capital. These are the three factors. There is a fourth factor, which is the root cause. And that fourth factor is paying too much attention to how much money somebody else has made in the stock market. That really causes these factors to come into place. Now, all this gyan that I'm giving you didn't come in one day. It is a result, it's accumulation of the hard knocks that I and my colleagues have faced in our career as portfolio managers. in today's presentation, in today's discussion, I want to take you through not just examples, but I want to take you through the thought process that evolved over a period of time. What were the events that led to this thought process, and so that you get a better understanding. Let's start with the early 90s when we were, rookie fund managers. I'm talking of, State Bank Mutual Fund and also 20th Century Mutual Fund that became Zurich Mutual Fund. I was fortunate enough to work with the two stalwarts of the asset management business, Prashant Jain and Chandresh Nigam. Prashant Jain, of course, is the CIO of the HDFC Mutual Fund today, and Chandresh is the CEO of Axis Mutual Fund. We were colleagues in 20th Century Mutual Fund that later on became Zurich Mutual Fund. This were the kind of the first hype that we were caught up with. This is the IPO boom. I don't know how many of you remember this. These were the days immediately after the Controller of Capital Issues was, disbanded. And many companies came out with public issues, usually at 10 rupees or 12 rupees. And there was a craze to just get firm allotment in those public issues and then sell them on listing. If the share was issued at 10 rupees and got listed at 12 to 13 rupees, you made 30% return in a few weeks' time. And that was a good way to make money, and it seemed infallible. We were also caught up in that hype. And look at the data here. In 91-92, India issued a total of 1,400 crores in IPO money. That amount rose to 13,000 crores in 94-95. And we were caught up in this hype during that period. And many issues where we successfully got out, but some issues we got stuck. 2 years we spent, the three of us spent in cleaning up that portfolio. Right? A good part of 2 years was spent. We bit on the bullet and decided that we will not fall for hype again. We will just clean up the portfolio, even if it is painful, and stick to quality and valuations in our careers, in the future careers as portfolio managers. That was an important learning that we had. Some of the names I'll share with you. You may puke at some of them, but all of them seemed extremely, exciting stories at that point of time. Some of them, these were the names, some of the names that we bought in our portfolio. I have brought it up from memory. I might have missed a few of them, but all of them seemed extremely unique and great growth prospects at that point of time. Now, after going through this trial of fire and resolved that we will not make this mistake again, we were ready for the next hype that came. And it's important to realize that periodically, there will be huge hypes in the stock market. We have to be ready with them. We have to be ready to face them. The three big hypes that we have seen, three big booms that we have seen after that in the Nifty is the technology boom of 99-2000, the infrastructure real estate boom of 2007, and what I call the quality at any price boom in 2019 and 20. It came from 2018 to 2020. In between, we saw the mid-cap boom of 2016-17, and we also saw the NBFC housing finance boom of 2018. That is not reflected in this because this is a Nifty chart. Now, why am I saying all these things? Because in any bubble, when we know it is a bubble after we have crossed it, but during the bubble, there are two essential ingredients to any bubble. Number one ingredient is an insatiable desire of a great many investors to invest only in the product that gives the highest return. That is one essential ingredient of a bubble. The second ingredient is the willingness and claim of a portfolio manager or a fund manager to fulfill that desire of the investors. Both are essential. Now, we can't control the first one, but we can certainly control the second. As portfolio managers, we can control the second and not make tall claims about our ability to generate high returns at consistency. That is, after the 1995 IPO boom, when the technology boom came, let's look at some of the stocks that were popular during that time. These were the names at that time. There were some great companies and there were some not so great companies also. I'll give you some examples. Global Tele Systems was one of the most popular stocks at that time. It is GTL Limited. Just look at the data. The 5-year average P multiple of GTL for a 5-year period ending 31st March 2000 was 6.7. But as of 31st March 2000, it had a P multiple of 40. Now, how do you conclude that there is a hype? There must be some quantitative measure to determine that. The quantitative measure that I use, look at the valuation of the company in relation to its historical average valuation. And when something is trading at nearly 7 times its historical average, you know there is a tremendous amount of hype in that. And look at the result of somebody who bought GTL at the peak. He suffered a 47.3% negative return compounded for the next 5 years. And even great companies were not spared of this hype. You know, Infosys had a 5-year average P multiple of 28.25, but as of 2000 March, it had a P multiple of 94.4, and even a stock like Infosys suffered a minus 1.4% compounded return for the next 5 years. The most hyped up stock, in my opinion, during that time was Visual Soft Technologies. It was listed in November 98, and from November 98 till March 2000, it had a average P multiple of 88.9. That itself is high, but as of March 2000, it had a P multiple of 241.7. And not surprisingly, it suffered a minus 57.8% compounded return for the next 5 years. The point is, even during this mad time of March 2000, there were good quality stocks available. And some of them found their way into our portfolio at that time. Nestle was going begging at 3,300 crores market cap. Nobody wanted Nestle. All these companies, by the way, ladies and gentlemen, were called old economy companies or bricks and mortar companies. Whereas the other companies were called new economy, and the hype was only about the new economy at that time. Information technology, telecommunications, and entertainment. These were the only 3 sectors that performed. Stocks like State Bank of India was ignored. Larsen & Toubro was ignored. Larsen & Toubro was available for 9,568 crores market cap. But during the next boom, I mean, if you had just bought it during the peak of the technology boom and held it to the peak of the infrastructure boom, you made 38.3% compounded return for the next 5 years. Nestle, you made 20.6. State Bank of India, you made 33.5. Now, this is one example. There were other examples. The next boom I spoke about was in December 2007. Let's take some examples from that boom. In December 2007, the story changed from IT to infrastructure and real estate. You know, the same set of factors. The investors trying to get the maximum returns from any source, and fund managers who were willing to, commit themselves that they will deliver those returns. Unitech, for instance, had a 5-year average P multiple of 10.19 in December 2000 for the 5-year period ending December 2007. As of December 2007, its P multiple was 60. And for the next 5 years, it suffered a minus 41.3% return. What's interesting is Larsen & Toubro, which was ignored in the previous boom of information technology, was not ignored at all. It became extremely overhyped in this boom. 13.52 was the average P multiple of Larsen & Toubro for the 5-year period ending December 2007. But as of December 2007, had a P multiple of nearly 43. And not surprisingly, it suffered a minus 4.9% compounded return for the next 5 years. Same thing about Reliance Industries. No, the point I'm saying is, hypes, the nature of the hype doesn't change, but the ingredients of the hype changes. And even during 2007, there were companies that were available, good quality companies that were available at a reasonable price. Some of them were really good quality. Hindustan Unilever, it may surprise many of you to know that Hindustan Unilever was shunned in 2005, 2006, and 2007. Nobody wanted to buy it. Procter & Gamble, nobody wanted to buy it. Because why? Because from 1999 till 2007, the stock didn't move. It didn't move till 2009. For nearly 10 years, lever didn't move. And that is a cardinal sin any company can commit in today's stock market. If it doesn't move, nobody wants it. But Hindustan Lever, when something like that is available at a dividend yield of 4.5%, and when something like that is available at a steep discount to its 10-year average valuation, you should just buy it. That's what I did in my portfolio at that time. It was my portfolio during those times used to be called a portfolio for widows. It gives only good dividend yield and it doesn't grow at all. And people used to make fun of this portfolio at that time. But look at the returns. infrastructure gave -40 and -30% return for the next 5 years. Hindustan Unilever gave 18.4% return for the next 10 years. Asian Paints gave 27.4, Procter & Gamble gave 27.8, and GlaxoSmithKline Consumer, which is now part of Lever, gave about 23.2% compounded return. So this is the second example. The third hype, of course, is the mid-cap hype, which all of us remember. This happened only about 3-4 years ago. Mid-cap index, for instance, had an average P multiple of about 22 times, for the last 15-16 years. Even in 2013, 2014, there were several mid-cap companies that were available at single-digit P multiples. And the entire index was available for about 14, 13 P multiple. Then suddenly something happened. In the next 2 years, the P multiple of the index went to 110. And guess when the maximum inflow into mid-cap funds happened? It was during this period. I have known people who proudly claimed that 85% of their portfolio was in mid and small cap funds during this period. Now, I couldn't do, apart from trying to warn them, which those warnings went completely unheeded, I couldn't do anything. And then it suffered the same inevitable fate which all hypes suffer. So the point is this: when something is overvalued, when something is clearly overvalued, the best thing to do is to stay away from it. You may underperform for some time, but that's okay. I'll come to that a little later. Why does entry price matter? I want to share this 2 important slides with you. I've taken one of the most well-known companies of India. There is a point of view that when earnings growth is robust enough, the entry price doesn't matter. But look at the data here. This is Infosys from 2000 to 2006. The earnings growth of the company was 35.7% compounded per annum from 2000 to 2006. Nothing wrong with the earnings growth. But the stock grew only 4.2% during that period. But the same Infosys, between 2016 and 2019, showed an earnings growth of only 3.2% per annum. But the stock grew by 20.6% per annum. What is the crucial difference? Infosys in 99-2000 was at a P multiple of 95, nearly 100 times. The same Infosys in 2017 was available for 12.5 P multiple. So the entry price is a very, very important factor in the returns that we generate. And in bullish times, people tend to forget this important point. That's my submission to you. Why do people get carried away in a bull market? These are the common reasons given. And the most common reason is what we already discussed. My neighbor has made big money in XYZ stock. I have made only 18%, but he has made 25%. This is the primary reason for the problem. If we are unable to digest the fact that somebody else has made more money than us, that is a serious issue. First of all, 18% is a very good return. Secondly, if somebody else has made 25%, maybe he is better than us. Maybe he is a better investor. Maybe he was plain lucky. Maybe this year he made more money, but next year our stocks will make more money. But this doesn't, very few people think like this. If somebody else makes more money, it's impossible for many people to tolerate that. And in the anxiety to give the highest return, crazy risks are taken in the portfolio. So this is the first reason. The second reason is, if we don't buy when stocks are going up, when will we buy? Which is why there is a great deal of effort in trying to predict when the market will bottom out, when will it peak out, and so on and so forth. As we have seen, ladies and gentlemen, when the market bottoms out, when the market peaks out, is irrelevant for a stock picker. So we have seen that even if you buy at the peak of the technology bull run, some stocks, and held it till the next bull run, you made very decent money. At the same time, you lost very, very large amounts of money if you buy the wrong kind of companies. So what matters is what we buy, how much of it we buy, and at what price we buy. The third reason is we can always sell it off when it begins to fall. Market provides enough signals for downturns. Participate as long as the music plays. This is a common thread that I hear, especially from people who think that they can time the market. I grant that some people can time the market. Maybe 0.5% of all investors can time the market successfully and sustainably. But all of us belong to the other 99.5%, and let's not have any illusions about it, right? The other factors that lead to people to get carried away is that there is always a premium tag attached to the person or fund that has delivered the highest return. The desire to be number one, even when the valuations are dangerously high, is what makes most investors take crazy risks, right? During a bull run, the fund that has given the portfolio that has given the highest return is usually the portfolio that is overweight on the hot sector, and the hot sector is usually expensive. So this risk factor is forgotten during a bull market. The last thing is the fear of looking like a fool. When I make 18% and my neighbor makes 25%, and especially when he comes and brags to me about it, I look like a fool. But my submission, ladies and gentlemen, is that it is much better to look like a fool than act like one. And buying something at 100 P multiple is not my idea of intelligent behavior. So that's the submission I want to make to this group. So what is the alternative? We said that these are bad things. So what do? Just stay away from highly expensive valuations. That's all that one needs to do. You don't have to precisely predict what exactly the valuation of a stock should be. Benjamin Graham has said it beautifully. You don't have to know a man the exact weight to know that he's fat. Just look at him, you know that he's fat. Just look at a stock, you know that it is expensive. Something is, the method that I use is that if something is greater than one standard deviation compared to its historical average valuation, don't buy that stock. It's okay. There'll be other opportunities. Boss, there are 6,000 listed companies in India. We need 25 to build a portfolio. We will find our 25. You don't have to swing at every opportunity. It is not necessary. When we do this, at the most, what will happen? We may underperform for a while, right? That's okay. Everybody underperforms for a while. Have you seen any fund that is consistently at the top? Have you seen any portfolio that is consistently at the top anywhere in the world? Everybody underperforms at some point of time. No investor, no fund, no PMS, no AIF, and indeed no investment style is constantly at the top of the performance table ever. So why are we trying to change that system? Why are we trying to change that the truth? It is not going to change. Let's accept the fact. At some styles will do well at some points of time. Other styles will do well at other points of time. The investor's job is to pick 3 or 4 differing styles so that his risk is spread out over 3 or 4 different types of products. That is what is important. Now, I said that I'll buy when the stock is unpopular. There are advantages to doing this. Because when a stock is unpopular, it is cheaper because there is less demand for it. When something has less demand, it is naturally cheaper. Buying a stock when it is cheaper enhances the chances of success over the long term. In every form of economic activity, buying when it is cheaply available or inexpensively available is considered the right thing to do, except in the stock market. Right? So we can't prove go against the tenet of economic logic. Unpopular stocks allows us to accumulate a decent quantity because when it is still unpopular, you can build up 4 or 5% of your portfolio with that stock. If you just buy 0.2, 0.25% of a stock, and even if it quadruples, it doesn't make any meaningful impact on the portfolio. The 2 important ingredients in this style these are extremely important, and I want to emphasize this. I put it in red. Absolute insistence on buying only very strong business model. You can't buy junk just because it came cheap. It doesn't work. The second is the willingness to be patient, because just because we buy the share, it need not turn popular the next day onwards. It will remain unpopular for some more time, or it may become even more unpopular after we begin to buy it, in which case we should be prepared to buy more of it. That's the second important point. The last point I want to cover in this slide is that we want to buy good businesses and we want to buy them at a decent price. But a good business is available at a decent price only when it is facing some difficulty. When you and I can see the profits are booming, so can the rest of the world. So when the rest of the world is excited about a stock, it is not cheap. And when you buy when it is not cheap, you should be prepared to pay the price for that. So the point is, our research, our effort should be to ascertain that the difficulties the company is facing are not terminal. They are temporary. That is the extent of the research. Our research should focus on that. The problem the company is facing is temporary and not terminal. The company is fundamentally capable of competing in the marketplace. That, I think, is the most important job of an investor. The assessment of the competitiveness of the company is the most important job. After that comes, the pricing and all that. I'll give you some examples from my portfolio over the last few years. I'll take 2 or 3. I don't have time to look at everything. I'll take 2 or 3. We spoke about Infosys. In just 3 years ago, just over 3 years ago, Infosys was available for 12.5 PE multiple. I was surprised to find that almost nobody had Infosys as amongst their top holdings at that time. Nobody, except the technology funds. They had to buy Infosys. What was the reason? There were 4 or 5 reasons that came at the same time. Number one, there was a public spat between the CEO at that time and one of the founders of the company. Everybody knows about this, so I don't have to repeat. The second reason is there was an accusation that in the acquisition of Panaya, a company called Panaya, there was some hanky-panky. Third, there was a fear that because Donald Trump had become the president of the USA, he will not give visas to Indian IT engineers, and therefore Infosys business model is shaky. Fourth, there was a lady called Punita Kumar Sinha who was a member of the board of Infosys at that time, and there was an accusation that because she was the wife of minister at that time, Jayant Kumar Sinha, the accusation was that a union minister's wife has no place on the board of Infosys, and this was the reason actually given. And there were other reasons also. All of them have happened roughly simultaneously. We went through all these reasons and we came to the conclusion that here is a company that has a great track record of more than 25 years, a great cash reserve, a strong balance sheet, a track record of treating shareholders well, definitely above average management, significant improvements in processes and training systems for the employees, and available at a valuation that is 33% cheaper than its 15-year average. When you get something like this, you shouldn't bother about whether it will outperform the next 1 month or next 3 months. When you get a stock like Infosys, which has an average P multiple of 18 times for the last 15 years, suddenly available at 12.5 times, you just buy, which is what we did. One more example, of course, Divi's Laboratories, which you're all familiar. There was a US FDA notification that came, which made the stock tank. We in Divi's at that time. But in December 2016, this notification came and the stock very sharply fell. And we doubled our position in Divi's at that time. I wasn't sure when this problem was going to be solved. But I was confident looking at the strength of the company that the problem will be solved because I have tracked Divi's for 15 years. So I know I was confident that it will be solved. But the only thing was when the time horizon was uncertain. I was willing to wait, and the valuation at which we bought Divi's at that time, it was available for less than 600 rupees. Today, Divi's is 3,700 rupees in less than 3 years' time. So the point I'm saying is this: in all these cases that you see on the screen, all of them were strong companies. Abbott today is more than 16,000 rupees, but 3 years ago it was 4,500 rupees and nobody wanted it. Why? Because it had underperformed for 2 years prior to that. That was the only reason. Everybody agreed that Abbott was a good company. Everybody agreed that Hindustan Lever was a good company in 2006, 2007, but not many people were willing to buy. So contrarian investing, the only difference is that the time horizon involved is longer. That's all. We don't need any special quality intelligence. We don't need any great, ability to predict what is going to happen. We just need a longer time horizon. That's all. I'll skip 1 or 2 slides because time is of essence. Does this work? All this is good in theory, but does this work? This is actually my track record for the last 17.5 years. This is after expenses. During this period, the alpha generated per annum is more than 4% after expenses. This is actual returns for all clients cumulatively. Right? This is not, the best client's return or anything of the kind. This is, of course, in 3 different organizations, but the approach to investing has been the same. But I concede the fact that not many investors will have a 17-year time horizon. So what I've done is I've broken up this track record in 3 different tables. The first table that you see on top is 1 year time horizon. The second table is 3-year time horizon, cumulative. And the third is 5-year time horizon, cumulative. So if an investor has a 1-year time horizon, in 61% of the years, this strategy has beaten the benchmark index after expenses. if the investor has a 3-year time horizon, in 73% of the years, the strategy has beaten the benchmark index. In 5-year time horizon, in 77% of the years, 77% of the data points, the strategy has beaten the benchmark index. So this strategy works when the time horizon is slightly longer. It doesn't work for a shorter term horizon. What is also important is, in these 17 years, there have been 4 years in which the market has given negative returns. During the Lehman crisis of 2008-9, during 2011-12, and 2015-16, and 2019-20. These were the 4 years in which the market itself gave negative returns. In each of these 4 years, the protection of the portfolio has been much better than that of the index. For example, during the Lehman crisis, the index fell 40%. This portfolio fell 10.9. During the pandemic-induced panic, the index fell 28.4. The portfolio fell 21.5. So the point is, it is not important alone for the fund manager to outperform in bullish times. How less he underperforms in bearish times is also important. So this portfolio fulfills that need. That is and over a period of time, it has given, as we have seen, a 4% alpha over the benchmark index. This is the process that I follow. I said that I want to avoid these things: low quality businesses, poor management, and exorbitant valuations. So by principle of inversion, I want to invest only in good quality businesses, measurable good quality. I'll come in the next slide what I mean by this: good management and attractive valuation. So this reduces the chances of permanent loss of capital to achieve above average return. I'll take a minute to explain what I mean by a good quality business, what I mean by good management and attractive valuation. There are 6,000 listed stocks in India. Obviously, we can't study all 6,000 of them. So the filters that we use is, number one, the company should have at least a 15-year track record. I don't buy anything new. I don't buy anything untested. So it should have at least a 15-year track record for me to even look at it. Number two, it should have revenues, a minimum scale of operations, which I define as 500 crores of revenue. After these two, I look at consistency in return on capital and consistency in positive free cash flow. Because in every year we calculate this for the last 10 years, and every year of positive free cash flow gets the company a score of 1. Every year of 20% return on capital gets the company a score of 1. So the maximum score any company can make is 20 out of 20 on these two parameters. My cutoff is 14. So for qualifying for the investment universe, a company should be at least 15 years old. It should have at least 500 crores of revenue, and it should score at least 14 out of 20 on these parameters. Out of 6,000 companies, about 200 companies qualify. So this is the investment universe. From this, we look at companies with good capital allocation history, if there are no serious corporate misgovernance issues, and the track record of increasing market share, and the expectation of growth in the future, because we don't want to just buy a company that has done well in the past. We also want to buy into a company that is capable of competing in the future. So based on whatever research that we do, we should be confident that the revenues and net profits of the company will be substantially higher in the next 3 to 5 years compared to what it is today. That's the research that we do. I don't want millimetric accuracy in earnings estimate, but we should be confident that it is capable of growing faster than competing companies. That's all that I'm interested in. And after all this, I want to buy the stock by not paying an exorbitant price. An exorbitant price, according to us, is a valuation that is more than one standard deviation higher than its historical average, or a valuation that is greater than its estimated sustainable growth rate in earnings. So these are the two things that we see. So if it qualifies on these parameters, we buy the stock. And of course, there are about 25% reserved for exceptions to this rule, because no finance company, no bank will qualify on these parameters. We can't completely leave banks and finance companies from the portfolio. So we have given a commitment that at least 75% of the portfolio of the client will be from this list, and 25% for banks and finance companies, and maybe companies which are less than 500 crores, or maybe cyclical companies which are completely beaten down, and so on and so forth. So that take up the balance, maximum 25%. In terms of exit strategy, when the assumption, these are the reasons why I sell a share. When the assumptions with which the stock was purchased in the first place are no longer valid, then I sell. When the stock price goes well beyond what we think it is worth, then we sell it. The third is for the same level of risk, we spot a superior opportunity. Then if I buy company A because company B was too expensive, and after 6 months, company B becomes cheaper than company A, then I may switch from A to B if the valuation differential is significant enough. And fourthly, when there's a redemption request, either a full or a partial redemption, then I have to sell. These are the only 4 reasons when I sell a share. And if it doesn't meet these 4 requirements, I'm happy to hold on for months or years together. Our churn ratio in the portfolio ranges from 15 to 20%. And these are the risk management factors that we have put in place, not more than 10% in a single stock, not more than 30% in a sector. And sector is defined by the GICS classification. And the minimum of 4 non-correlated sectors to be there in the portfolio, no derivative position, no leverage position. And the average traded volume for the stock should be sufficient for us to liquidate the entire holding in 5 trading sessions. So this is the kind of risk management that we have put in place. Now it's almost 6:15. So I have 2 examples. So Nimisha, can I take both of them or just one of them? How does the time permit us?
So we could first finish the first example, and then depending on the time, we could decide whether we have time for the next one.
Okay. Now, these are live examples which are there in my portfolio right now. Both of them are not very popular right now. I will leave it to the audience, or I leave it to you, Nimisha. I have got Bosch and ITC. Which one do you want me to discuss?
Audience, can you quickly maybe, put the company name in Q&A box? ITC. I think unanimously we have got high demand for ITC.
Okay. I'll discuss ITC. This is Bosch. Okay. Now, this is not a popular stock as of now. Everybody knows this. There are enough hate mails that are coming up about ITC, but this is one of my top holdings. I want to share with you my thought process. I'll appreciate if you could share, your feedback on this. I'm not claiming to be infallible, but this is the thought process that I've employed in buying ITC. And this is the thought process I have employed in all my major positions. I buy companies which I believe are strong, but I buy them when they're unpopular. This is the case for ITC. I am not buying ITC for its tobacco business. Let me make it very clear. I am buying ITC because I see a potential food giant in the next 8 to 10 years. That is the reason I'm buying ITC. And it fits in very well with the long-term theme of growth of India's middle class and the propensity to spend on packaged foods and personal products. I think that there is enough evidence that ITC is doing the right things by building a good supply chain, by building a good distribution network, by introducing good quality brands, by successfully introducing brands and scaling them up, and investing in new factories for food products and so on and so forth. So this is made ITC already the 2nd largest consumer staples company in the country, but still the market refers to ITC as a tobacco company only. It is 2nd only to lever in FMCG business, but still the market refers to it as tobacco. Now, look at the data. 10 years ago, ITC's EBIT was 330 crores negative. Last year was 420 crores positive. It is very small, I agree, compared to its overall EBIT, it is small, but the trend is very encouraging. And in the last 5 years, the EBIT growth has been 65% compounded. On a small base, I agree, but it is encouraging. Let's look at the trajectory of EBIT margins. 10 years ago, it was minus 7.4%. Now it is about 5.6% in the last half year, sorry. Look at the quarterly EBIT margins of ITC. Every quarter is better than the corresponding quarter of the previous year for the last 5 years. The second quarter of 2020-21 is 7.2% EBIT margin. Second quarter of 2020 was 2.8%. Second quarter of 2019 was 1.8%. Second quarter of 2018 was 0.7%. Second quarter of 2017 was minus 0.1%. Second quarter of 2016 was minus 0.5%. Now, is it as good as Nestle or Lever? No. But is it encouraging? Most certainly, yes. I think they are doing the right things, and it will take some time for them to show good quality results, the kind of results that we want to see. And I'm encouraged by the fact that something similar happened to Nestle. Nestle, if you know, introduced Maggi in 1983, right? In 1994, 11 years after Maggi was introduced, Nestle's overall EBIT margin was 9.9%, which means that it is extremely likely that baby foods and instant coffee were subsidizing Maggi, which is what tobacco is doing to the FMCG business of ITC today, right? Today, Maggi is a money spinner. Overall EBIT margin of Nestle is 22%. And this fall is when the Maggi controversy happened in 2015. But look at this, 9.9% overall EBIT margin, when I'm extremely confident, I don't have the breakup here, but I'm confident that baby foods and coffee were subsidizing Maggi at this point of time, which means that 11 years after it was introduced, Maggi was still making losses. Look at the track record of ITC. I have broken it up into 5 years periods, right? I'm comparing it to the 2 top companies in FMCG in the country. Just take the last 5 years. ITC has done better than Lever. It is almost done as well as Nestle in the last 5 years. But the stock price, ITC has been minus 4.6% compounded. Lever has been 21% compounded. Now, I'm struck by the similarity between ITC of today and Hindustan Lever of 2006. Look at this chart. Hindustan Lever in 2006, the 5-year period ending 2005, Hindustan Lever gave minus 11.37% compounded return. During that period, ITC gave 12.59% compounded return. But the time to buy Lever was this. The price to buy Lever was this. So I'm seeing a similar pattern here. ITC has done well in terms of fundamentals, but in terms of stock price, it hasn't done well, which is why I want to buy now, right? Look at the 15-year average fundamentals of ITC versus Lever. Revenue growth, ITC has been 12.9%, Lever is 9.1%, Nestle is 12.2%. Operating profit growth, ITC 13.7%, Lever 12.5%, Nestle 14%. Net profit growth 13.8%, 12.2%, 14%. Operating margins, average for the last 15 years, ITC 29.5%, HUL 17.3%, Nestle 20.9%. So despite doing better than Lever and almost as well as Nestle for the last 15 years, look at the stock price. ITC is trading at a trailing 12-month P multiple of 17.6. Hindustan Lever at 71. This is updated till November end, okay? Nestle 82, trailing 12-month P. Dabur 69, Britannia 50.9, Marico 44, Pratap Snacks 32, Jyoti Laboratories 28, Procter & Gamble 62. Now, I have nothing against any of these companies, but let's not forget that ITC traded at a premium to Hindustan Lever just 6 years ago. Today, it is trading at a 72% discount, whereas its last 10-year average discount to Hindustan Lever is 27.8. When something has an average discount to Lever at 27.8 and today trades at 72, it is my humble opinion that the discount level is unsustainable, which is why I want to buy it now. Same thing with Nestle, but somebody has to convince me very hard why Pratap Snacks should trade at 32 P multiple and ITC at 17 P multiple. Look at the fundamentals of the company. Consistently high return on capital. Average 5-year average return on capital is 35%. Debt to equity is 0. Free cash flow last year was a 15,000 crores, right? Every year he generates free cash flow. And look at the PE chart. 10-year average PE is 25.3. 1-year forward PE is 14.7 according to Bloomberg. This is not our estimate. This is Bloomberg's estimate. When you get a company like ITC, is it a weak company? Everybody agreed it is not a weak company. Is it a company with a weak balance sheet? No. Does it have distribution skills? Yes. Does it have brands? Yes. Does it have a strong balance sheet? Yes. Does it have good profitability? Yes. Does it have good cash flows? Yes. Is it a liquid stock? Yes. Then why the hell should it trade at 14 P multiple? This is my logic. Of course, I'll be happy to listen to alternate points of view. Look at this. These are 11 good quality consumer companies that I've compiled, not necessarily in any order. These 11 of them have net profits cumulatively of 13,800 crores. and cash flow from operations of 14,300 crores. Their market cap cumulatively is 9,15,000 crores. ITC alone has 15,500 crores of net profits and 14,700 crores of cash flow from operations, and its market cap is 2,38,000 crores. Now, I concede that it deserves to trade at a discount to lever. I'm not disputing that. But how much of a discount? That's my point. And the extent of the discount is the opportunity. And there are talks about ESG compliance, right? You might have heard of all this ESG compliance. So we talk a bit about the ESG ratings of ITC and other companies. There are two agencies that rate ESG, MSCI and Sustainalytics. This is a Morningstar company. ITC ranks AA. Reliance ranks BB. Hindustan Lever ranks A. Tesla, which is supposed to be the greenest company in the world, ranks A. ITC is AA. And in this Sustainalytics rating, ITC is ranked medium risk, right? Tesla is ranked as high risk. Reliance is ranked as high risk. So are we going to go by perception or are we going to go by actual reality? I would prefer to go by reality. This is a reality. The ratings of ITC are in no way inferior to any other company. We have a company that is extremely profitable. We have a company that is liquid. We have a company that is doing the right things. And we have a company that is extremely cheap. I'll stop here. I mean, I don't want to bore you with too much details. I'll stop here. I just want to share two quotes from one of the favorite books of mine, David Dreamen's Contrarian Investment Strategies. Respect the difficulty of working with a mass of information. Few of us can do it successfully. In-depth information does not lead to in-depth profits. I'm saying this because I've seen some people trying to find out everything about a company before they invest a single rupee. It's not possible. We have to just determine which are the 4 or 5 points we want to make a decision with and then go ahead with it, because 100% information is never going to be available. The second and most important quotation from that book is, positive surprises result in a major appreciation in out-of-favor stocks while having a minimal impact on favorites. Negative surprises result in major drops in the price of favorites while having no impact in out-of-favor stocks. I would qualify this a little. It may not have virtually no impact. It may have a smaller impact. That is my modification to this quotation. Ultimately, the stock market moves as a result of expectations only. When the stock price goes up, it's as a result of an increased level of expectation about its future performance. When a stock falls, it is because some expectation has not been met. That is the only reason why a stock goes up or falls. So my submission, ladies and gentlemen, is let's look at companies, strong companies, capable companies, where the level of expectation is low to begin with. So the possibility of disappointment is lower. I'll stop here. I'll open up for questions. Thank you. Thank you for your patient hearing.
Sir, that was a fantastic session. We wish we had more time. So I'll quickly move to the question and answer round. So first, I have my own question. I'll play a devil's advocate, and maybe I'll argue that it's not always possible for us to be right. Sometimes the market's negative sentiment about a company or industry might be justified. So how do we identify that? And especially if we have already taken a position, contrarian view, and then subsequently, how should we continuously evaluate and confirm whether our thesis is right or market's view is right?
Fair enough. Now, both are important and good questions. Let me take the second one first. I am not advocating that we buy at the first sign of fall. I am advocating that we buy after it has substantially fallen, right? So if something has gone to a peak and it has fallen well below its historical average valuation, the comfort comes in the sustained competitiveness of the company. We are not buying a company that is incapable of competing. We are not buying a company simply because the price has fallen. We are buying a company that is capable of competing, but something that has fallen substantially from its peak and it has fallen to substantially below its historical averages. That is point number one. The second point I made was we have to satisfy ourselves that the company's competitive position is in no way harmed and it is capable of growing its net profits and revenues in the foreseeable future over the next 3 to 5 years. It may have a problem in the next 3 to 6 months, but if it has a terminal problem in the next, in the next several years, we are not going to obviously buy it. that is the first point. The second point is your first question. We can't be right all the time. I agree with you. I certainly can't be right all the time. But my intention is to be right in 7 out of 10 occasions. If I'm right in 7 out of 10 occasions, the client has a decent result. If I'm right in 8, he has a very decent result. 9 out of 10 is not possible for me, and I don't believe 10 out of 10 is possible for anybody.
So in those 2 to 3 cases where you might be wrong, do you put any stop loss in terms of price or a time? So how do you recognize that mistake?
I think price is, I told you I buy substantially after it is substantially fallen. So price is not stop loss. The stop loss is I have a waiting period of 3 years. So if the fundamentals don't improve, if the fundamentals don't significantly improve, or if the stock price refuses to move for 3 years, then I will sell it. That is my waiting period. And there have been cases like that. Obviously, I am not disputing it. There have been cases where I waited. The fundamentals were nothing wrong with them, but I have been, I waited for 3 years, and that is my time horizon. If it doesn't move in 3 years, I cut my losses and go.
Thank you. That was quite useful. Then there were a couple of questions on valuation. So in your examples, you mainly mentioned about PE. So the questions were, is PE always the right metrics? When should one look at maybe enterprise value?
PE is not always the right metrics. In not all businesses you can use PE. For financial companies, I use price to adjusted book value. Right? In some cases, I use enterprise value to sales or market cap to sales, especially in cyclical kind of businesses. I use enterprise value to sales or market cap to sales. But whatever metric is used, the same metric is compared for the last 10 years. So I take 10-year average valuation. I also take the earnings growth or book value growth for the next 2 to 3 years. That is how is my measure of future performance. So PE is not always the right. Sometimes we do discounted cash flow analysis and compare it to the present market price. But discounted cash flow you cannot do for all businesses. There are some very steady state businesses where you can do discounted cash flow. Highly volatile businesses, discounted cash flow. There are too many assumptions involved, so it doesn't work that way.
Right. So basically,
but you're right. You can't use PE for all businesses uniformly. You're right there.
Right. So you need to understand the nature of business, understand what is the basic driving factor for that business, and then value it accordingly.
Correct.
A similar question on valuation was, is there any difference in how you value PSU, maybe, banks or any other manufacturing PSU versus private sector? So is there any PSU discount which you apply?
No, the discount is already in the average valuation of the company, right? For example, I have both HDFC Bank and State Bank in my portfolio, right? Now, State Bank of India, I will compare to the average valuation that State Bank has traded at for the last 10 years. HDFC Bank, I'll look at the average valuation that HDFC Bank has traded in the last 10 years. I cannot compare HDFC Bank valuation with State Bank valuation. It doesn't work that way. So the PSU discount, as you call it, is already in the comparison, right? So, and to answer your second question, my primary concern is to see whether the company is competitive enough. If it happens to be a PSU, so be it. There are some very strong businesses in PSUs also. So I don't want to just stay away simply because it is a PSU. I have no ideological bias against the PSU. But certain businesses amongst PSUs, I'll not buy it. But certain businesses in private sector, I'll not buy it. So the ownership of the company matters less to me than the ability of that company to compete in its marketplace. That is far more important to me.
Right. Thank you. That was quite useful. Then another round of questions is about what we may call is the today's new economy businesses, US tech businesses or platform businesses in India. So how do you look at their valuations? Does their higher multiples are justified considering the size, innovation, and growth potential?
Are you talking of private equity kind of companies or which sort of companies?
Listed, Amazon, Netflix, or in India maybe InfoEdge or MCX or not BSC but maybe NSC when it is listed. So these network businesses, they have high potential for growth.
See, I think that it has to come within my valuation metrics. So otherwise, I will not buy it. I am happy to let go of any number of opportunities. I am happy to lose opportunities. I simply don't want to lose money. That is my primary concern in life. So if this opportunity goes, I'll find another one. I have no problem.
Okay, so I think the what you started with, avoiding the losses or avoiding the mistakes is more important than just picking the winners. I think we have
Yeah, see,
time for
it's yeah, please.
Please continue. We have 10 more minutes.
Okay, no, the thing is, I think the primary risk that a portfolio manager has to guard against is the desire to be number one at all points of time, because it's not a bad desire to have per se, but markets are not always rational. Sometimes the market goes berserk. When the market goes berserk, exorbitant valuations are there in one or two sectors. So if you want to be number one at that point of time, you have to be heavily overweight on those sectors that are extremely overvalued. We have seen this in tech in 99, 2000. We have seen this in infrastructure, real estate in 2007. We have seen this in Midcap in 2016. We have seen this in NBFCs in 2018. Yes, so if you want to be number one in a highly raging bull market, you have to be overweight on a sector that is already overvalued. That actually is taking too much risk. So during such times, I don't mind underperforming. So it's important to communicate to the client exactly what you're doing and do exactly that. That is far more important.
Yes.
I hope I've answered your question.
Yes. There was a question on how to identify whether the current problems are temporary or permanent. And there is a high demand for, a case study of Bosch. So I think you can answer the first question through Bosch case study. We can have 5 minutes.
No, it's a question of, looking at the industry. I find this, everything we look at, that the theoretical framework of Michael Porter's five forces, I think that has always helped me. I think that is to determine whether the company continues to be competitive. That is one good thing we learned in MBA school. I think it helps us. The sustainability of the competitive position of the company by reading, by meeting people in the industry, by meeting competitors, by meeting distributors and the dealers of that company is what, and sometimes a competitor also is what we glean information. The information is never available in one go. It is available through different sources at different points of time. A compilation of all of these things is what gives us the confidence that here is a company that is capable of competing, right? From then, it goes on to prospects for growth. Then it goes on to the quality of management, what the company has done in the past. Has it done anything grievously harming minority shareholders, etc.? And here I have to caution you, there is no company that, at least anything that I am aware of, which is 100% pure. Everybody has some shades of gray. So beyond a threshold, we will not go. I mean, if it's grossly violated minority shareholders' interest, we will not buy it at any price. So that's the discipline that we have set for ourselves. But 100% pristine purity, we are not going to find in any company. So after all these things comes the valuation. The valuation comes last. So I want to dispel the myth that value investors or contrarian investors are interested only in cheap prices and nothing else is not correct. I look at valuation at the last end of the spectrum. First of all, I have to satisfy myself about all these things. If some junk is available at a cheap price, I'm simply not interested.
Yes, and we have a huge demand for Bosch. So if you could quickly share your thesis on Bosch as well.
How much time do we have? Because this will take some time. How much time do we have?
We have 5 minutes.
Okay, I'll have to quickly run through it.
So even if you don't share your slides or presentation, if you could just summarize your thesis, people can go over the slides when they have the time.
Okay, I'll give you very quickly the... See, I'll share 2 or 3 slides only, okay? Now, what is the fear in Bosch, really? The fear in Bosch is that there are 2 fears. One is slowdown in automobile sector. That is one fear. But the more important thing is that EV, electric vehicles, will be a death knell for this company. This is the larger fear, right? So what we did was, we took the EV argument to its extreme. We took the maximum optimistic projection for EV in this country and then saw what is the impact on Bosch. That is what we did. And I want to share that with you, the group here. Look at this. We started with the the Ministry of Road Transport plan that India will be 30% electric vehicles in the year 2030, right? So we said that 100% of the two-wheelers and 100% of the three-wheelers will be electric in the year 2030. It can't be more optimistic than this, right? And we said 30% of the cars and 10% of the trucks will be EV by 2030. The last one, I think, is extremely unlikely because trucks, a 30, 40 ton truck, which has to run 1,000 kilometers, is unlikely to turn EV that fast. But we have assumed 10% of the truck population will also turn EV. The second thing is, we looked at the Chinese example. China has been subsidizing electric vehicles for the last 10 years. $60 billion of subsidy has been given. And at the end of $60 billion in 10 years, 4% of the vehicle population is EV. India has approved $1.5 billion of subsidy, and we have a plan of becoming 30% in EV. But let's assume it happens. The second assumption is that every petrol vehicle, every diesel vehicle, every CNG vehicle purchased in this country will be scrapped 10 years after purchase. This is the second assumption. You and I know it does not going to happen, but we have assumed it will happen. So this is what we have projected. EV growth in two-wheelers and three-wheelers will grow from less than 1% to 100%. Cars will grow from about 1% to 30%, and trucks will grow from near to 0 to 10% over the next 10 years. With this, we calculate what will be the proportion of electric vehicles that will be running in Indian roads in the year 2030, based on the vehicle population that is available today. And usual disposal rate of 10 years. 23% of the two-wheelers, 23% of the three-wheelers, 6% of cars, and 2% of trucks running in the country will be electric, with these sort of assumptions. That is the first point. The second point is, let's look at Bosch's breakup of revenues. Bosch's non-automotive sales is 15%. So this is not going to be affected by electric vehicles. 21% of Bosch is aftermarket sales and spare parts and service. So this is unlikely to get affected at least for the next 15 years. Commercial vehicles are 25% of Bosch, and commercial vehicles, as we have seen, is going to be only 2% of overall commercial vehicles are going to be EV. It is very likely that city buses will turn electric, but it's highly unlikely that trucks, where Bosch supplies maximum, will turn completely electric in the next 10 years. But we have put that risk as negligible. Utility vehicles like Toyota, Innova, or Mahindra XUV are 16% of Bosch. 8% of Bosch is tractors. No, I can't imagine tractors turning electric in this country. Maybe by some miracle it will happen, but I have put that risk as negligible. Gensets are 2%, so this is unlikely to turn electric. So the high-risk areas are diesel cars 8%, gasoline cars 5%, and utility vehicles 16%. Together, they constitute 29% of the revenues of Bosch, which is high or medium risk to electric vehicle threat. The stock has fallen 50% from the peak. That is the second point. The third point is, look at Bosch's profitability growth for the last 20 years. Average profit growth has been 14.5%. But interestingly, look at years following the introduction of new emission norms. India introduced Bharat Stage 2 in 2002. In 2003 and 2004, Bosch's profitability shot up to 64% and 75% profit growth. Bharat Stage 3 was introduced in 2005. In 2007, Bosch's profitability went up by 60%. In 2010, Bharat Stage 4 was introduced. The next year, Bosch's profit grew 45%. This year, we have introduced Bharat Stage 6. India didn't introduce Bharat Stage 5, but introduced Bharat Stage 6. Now, because of COVID, the entire thing has been pushed back by some months. But I am betting that the next round of profit growth will come because of Bharat Stage 6 introduction. Because Bosch has a dominant market share in the equipment that makes vehicles compliant with Bharat Stage 6 norms. That is they've invested heavily in Bharat Stage 6 technology. That is point number 3. Point number 4, look at Bosch's press release, Robert Bosch GmbH press release in 2018. They are saying that their new diesel technology, compared to the European emission norms for 2020, has emissions of NOx 10 times lower than the limit set for 2020. And European emission standards are amongst the most stringent in the world. So diesel is not dead yet. especially when a diesel car is available for 40% of the price of a similar electric vehicle. Now, India's primary slogan is Satyameva Jayate. India's secondary slogan is value for money. Right? Now, if an owner of a purchaser of a new car gets a diesel car for 40% of the price of an electric vehicle, and the diesel car is compliant with the emission standards set by the government, the incumbent emission standards, it is my bet that he is not going to buy an electric car simply to buy an electric car, paying 2.5 times the price. That is a bet that we are taking, right? So that is the fourth point. The fifth point is, look at the track record of the company. Except the last year, is return on capital has been consistently about 20%. And let's not forget, Bosch is a cyclical business, so it has had a cyclical downturn. But it has always generated free cash flow for the last 10 years. Its debt to equity is 0. And its average 10-year P multiple is 37.7. Now the P multiple on a 1-year forward basis is 25. Are we buying a strong company? Yes. Are we buying a company that is supplying to the world's who's who of automobiles? Yes. By the way, Bosch also supplies to Tesla. Bosch worldwide supplies to Tesla. Bosch is contracted to supply to Bajaj Chetak, the electric scooter that is going to be introduced. Bosch is contracted to supply to Hero's e-cycle. So Bosch is already supplying to electric vehicle manufacturers, and they are not blind to the threat. Here is a company that has been at the forefront of automotive research for 150 years. Do you think you trust them more to deal with changes in technology, or you trust some analyst who's got some MBA from some fancy school and spent 5 years in tracking the automobile industry and is saying, sell Bosch? Who would you rather listen to? I would rather listen to the company itself. So this is my logic. Of course, there'll be people who disagree with me, but that's okay. The stock market exists because of a difference of opinion. We owe our salaries and bonuses and our profits to differences of opinion. So differences of opinion are welcome. I hope I have not overshot your time limit.
I think that was wonderful. I wish we had more time, and we'll definitely like to have schedule a longer session with you, hopefully soon. But thank you very much for your time and sharing all your insights and talking about the current examples, which very few people do. So as a reminder to all our participants, please complete the evaluation survey. CFA Society India members can claim the professional learning credit by logging in their online professional learning tracking tool. And thank you very much to Sir as well as all our participants, and have a very good evening.
I wish to thank all participants and also you, Nimisha, for organizing it very well. Thank you very much to the CFA Society. Goodbye.
Thank you. Bye.